where people go and find deals. I think there's an element of entertainment to that business model. How long and how much people are interested in sort of that random chance of getting a deal, I don't know. I would think as a public investor, you'd want to wait a couple of years to see how that model plays out. Of course, also there's 100 or more public companies or private companies already been launched doing the same thing, so there'll be a lot of competition. But there is so much desire right now to get into the hot companies that you have weird things going on. So well, you've got not too weird, but an interesting phenomenon. Shares posts, which most of you know about, is a way for people who own shares in private companies to put them on a market and sell them, right? So you've got a lot of people at Facebook and Zynga, Tesla selling their shares before Tesla was public. Well, you now have that phenomenon playing out, but there's investors and there's companies actually trying to, like Facebook now puts a pretty high surcharge if you want to exchange your shares. So to try to push down the effect of those shares going on shares posts. But you've got a couple of interesting new vehicles. One is this week a group announced that they're going to start a fund, a venture fund, and the only asset they're going to buy is secondary shares in Facebook, right? Which is pretty interesting. It shows you where the demand is. What's also interesting is you might remember a company just went public, I think this week, called Mail.ru. You guys know that one? So this is a Russian company. The reason they're up 30% from IPO, the reason they're considered exciting is because what they did, very clever guys, they bought really high valued shares in Zynga, in Twitter, and in Facebook, all right? Like the troika of Silicon Valley. And they put it in a vehicle, a public company called, or a private company called Mail.ru, which is a big like social network in Russia, and took it public. But basically the premise was, if you want to get a piece of those three companies in any meaningful way, this is the only way you can do it. So arbitraging their own private investment. By the way, I actually think this is a great phenomenon. While it's a little troubling that there's this bubble mentality popping up, the reason I think it's a positive phenomenon is a big problem venture capitalists have had since the dot-com bubble is the time it takes to get liquidity. It's just too long. 10 years is not considered now out of the ordinary. Some 12 years before you can go public. So being able to get liquidity in your key investments is very important. And one other thing about these top companies that are going public or have gone public in the Valley is that the venture funds that have invested in these companies, it's also fascinating. They are all in a very tough fundraising environment, being able to raise funds, like not overnight, but incredibly quickly. And if you look, I've now counted 6 venture capital funds, and again, it's a very out-of-favor sector, considered to be illiquid investing and with spotty returns, but 6 funds that have raised this year, all of them early-stage venture capital firms that have done it very easily, have all said in press releases or commentary that what did it was their investment in Twitter, Zynga, Facebook, Groupon. And what's also interesting about that is, regardless of the valuation they paid, because some of those funds got in at $1 billion, $2 billion, $5 billion valuations. So I hope the limited partners understand that, you know, the returns on something after $1 billion valuation cannot be that high.
Rob, you want to say something? You okay? Okay, go ahead.
Last thing I want to talk about here is something that's more down to the venture capital firms, maybe not as applicable to the audience, but does affect VC firms, which is the SEC, after studying the whole Bernie Madoff phenomenon, has now come back and yesterday, maybe it was Thursday, came out and said, all right, we're thinking of not requiring venture capital firms to be regulated like mutual funds. And that's been the idea, because they haven't really understood what a venture capital firm is. I think we've dodged that bullet, but they are talking about some egregious changes to VC firms. I was worried that there'd just be disclosure requirements, which are painful, and if you make mistakes, you can get sued and all that. That's tough because it takes time and money, but it's much worse than that. They've decided that debt is bad, And so one of the things they've said is, well, first we're going to define what a venture capital firm is. By the way, good luck in defining what that is, because I can't define it. But we're going to define it, and if you fall within that definition, you get a venture capital exemption. So you don't have to file as though you're a mutual fund, which, as I said, very onerous paperwork. But they said there's a couple of conditions we're going to require you if you're truly a venture capital firm. One, this may sound a bit wonkish, but it actually is an issue. You can't give any debt to your companies. The reason that's a problem is a lot of VC firms, when they're having trouble raising a round, they will give a bridge loan to the companies. It's very common. If we can't give bridge loans to companies, it's going to make it hard to save a lot of companies. The other, which is a real problem if you're a founder in a company, a real big problem is, they're also saying, by the way, and if you invest in any company, that money must be used to grow the business, period. Nothing else. So why the hell are they telling us how the company should use its money? And the reason I said it's a problem if you're a founder, one of the big phenomenons in the past few years has been, because it takes so long to get liquidity, what we call founder liquidity rounds, where VCs get into rounds by buying shares from the founders. So if we can no longer do that, founders no longer can get liquidity. And I'll tell you, this has been a big use of proceeds for VC funds in the last couple of years. So it's not yet a rule, but they came out this week and said, these are the things we're thinking about. And all I gotta say about it, this is all pretty much as a result of Bernie Madoff. Well, how this is gonna help the Bernie Madoff type of investors, I don't know. Venture capital is just different, we all know, from things like mutual funds and money management firms.
What's the timing on that?
They haven't said, but I would suspect 6 months.
Okay.
Yeah.
Glenn,
So,
quickly.
thank guys.
Get your
Bye.
deals done.